Today's lesson is about the basics of money and banking. If you are following along in your Econ 201 syllabus, the material in this video corresponds to material from Lesson 26. By the end of this lesson, you should be able to differentiate between barter, commodity, commodity-backed, and fiat exchange systems, and explain fractional reserve banking, including its impact on the money supply. To learn more about the material in this lesson, I recommend that you read the section on money and banking on pages 47 to 48 of your Blackboard lesson notes and chapter 27 of your online textbook. So, what is money anyway? We all know that this is money and that this is money. But did you know that for a long time people used these as money? And that during World War II, prisoners in a German prisoner of war camp started using these as money. You can read about this camp in this article, which is available to you on the Econ 201 Blackboard site. What made cigarettes useful as money? When we think about whether or not something will be useful as money, those things that we tend to use have three characteristics. They are portable, or easy to carry with you. They are divisible, meaning that you can split them into smaller units, and durable, meaning that they will last for some time. Do cigarettes have these characteristics? Certainly, they are easy to carry with you. They are also pretty easy to break into pieces, especially if you remember that the cigarettes that World War II POWs were smoking were unfiltered, which means that it was pretty easy to split them up into smaller pieces. Cigarettes also might last for a while, but since people could also smoke them, there was a limit to their durability. That said, of the items the POWs had available to them, cigarettes were the best choice in terms of having these three characteristics, and so they became the thing that people in the camp used as money. When we think about economic systems and the types of money that they use, there are four basic types of systems. The first are barter systems. In a barter system, one person exchanges their good or service directly with another person. For example, I might help a colleague make a video in exchange for them helping me with my taxes. These types of systems don't tend to last too long, since in order to make a trade, you have to find someone else who has what you want and wants what you have in exactly the right quantities. This problem is called the double coincidence of wants. The POW camp started with barter, but that didn't last because it was easier to use cigarettes as a common intermediate way to exchange goods and measure value. Cigarettes are an example of commodity money. With a commodity money, the item used as money has a value apart from its use as money. Cigarettes have this value, especially for people who like to smoke them. Gold is another example of commodity money. It is useful as money, but it is also useful for other reasons, such as making jewelry and in electronics. At one time, most countries used money that was backed by a commodity, such as gold or silver. We call these types of monetary systems commodity-backed systems. In a commodity-backed system, the item that is used as money is guaranteed to be exchangeable for gold or silver at a fixed rate. The United States used to have a commodity-backed monetary system. This is a $1 United States note from 1928. The holder of this note could exchange it for a little more than 1/20th of an ounce of gold. Although this note looks almost the same as the dollar bills that we use today, there are a couple of differences. If you have a dollar bill handy, take it out and compare it to this picture. Pause the video if you need to. You should notice that at the top of the bill, instead of saying Federal Reserve Note, it says United States Note. Another difference is at the bottom. Above the words $1, this note says, "Will pay to the bearer on demand," which means that the holder of this piece of paper could exchange it for gold whenever they wanted. Money in the U.S. was at least partially backed by gold up until 1971. When inflation caused by the oil crisis forced us to abandon this system. The last type of monetary system is what we, and most countries in the world, have today, is a fiat money system. In a fiat money system, the items that people use as money are useful to buy things and pay debts because the government says that they are. We've talked about what money is, but what does it do? Typically, we use money for three purposes or functions. The first thing that money is useful for is as a medium of exchange. When we use money as a medium of exchange, we give someone some of our money and they give us goods and services in return. In other words, we use money to buy things. Money also gives us a useful way to compare values of things. It serves as a standard unit of measurement. In the US, we can compare the dollar values of different items to learn something about how the market values these things. The last purpose that money serves is as a store of value. If you wanted to, you could save your money by stuffing it in a shoebox, and when you take it out a year later to buy something, you can still use it to make a purchase. Of course, I'm not recommending the shoebox savings plan, but it is one option. Now that we have a better idea of what money is and what it does, we're going to think about how much of it there is in an economy and how that amount can change over time. Although there are multiple ways to measure the amount of money in an economy, we're going to stick with the simplest definition, which is that the money supply is equal to all of the cash in circulation in an economy, plus all of the money that is deposited in checking accounts. Basically, we are going to count as money those forms of money that you could easily use to purchase goods or services. Obviously, it's easy to use cash to purchase things. And I hope that you agree that it's pretty easy to access the money in your checking account to make purchases, either by using your debit card or by taking cash out of the ATM. Why don't we count the amount that you could buy with your credit card as money? The reason why is that when you use your credit card, you're taking out a short-term loan. At some point, you have to pay that loan back. And when you do, the money that you use to pay it back is probably going to come from your checking account. So, by counting your checking account as money, we've already counted the purchases that you could potentially make with your credit card. We are now going to explore the magical topic of money creation. To begin, start by asking yourself what happens when you deposit money in your bank account. Does the bank just lock it away in its vault and forget about it? The answer, of course, is no. If the bank did that, it wouldn't make any profits and it would go out of business fairly quickly. When you deposit money in your bank account, the bank loans most of it out. That is how banks make money. The bank is only required to keep a small fraction of the amount that you deposit as cash in its vaults. This fraction is called the reserve requirement. We call this system in which the bank only has to keep a fraction of your deposit on reserve, fractional reserve banking. Up until 2 days ago, these were the reserve requirements that banks were subject to. The Federal Reserve, which regulates banking in the U.S., establishes these requirements. As of March 15th, in response to the stress on the economy generated by measures to limit the spread of the coronavirus, the Federal Reserve lowered all reserve requirements to 0. We'll talk about why they did this in our next lesson. If you want to read more about this policy change, pause this video and make a note of the link at the bottom of the slide. For now, we'll imagine that we're still living in normal times and assume that the reserve requirement is 10%. Suppose that you sell some stocks and deposit the $1,000 that you get from this sale into your checking account. Since stocks aren't included in our measure of the money supply, when you make this transaction, you add $1,000 to the money supply. The bank must keep $100 of your deposit as reserves, which means that it has $900 to lend out. The person or business who gets that loan deposits it in their account so that they can use it to make a purchase or pay bills. Note that this deposit doesn't have to be at the same bank to make this process work. It just has to be somewhere in the banking system. Since the amount in checkable deposits has increased by $900, the money supply has also increased by $900. The bank only has to keep $90 of that $900 in its reserves, which means that it can lend out the remaining $810. If that $810 is deposited, there is still $729 that can be lent out. And so it goes. As each loan is made, the money supply increases, as long as that loan gets deposited into the banking system somewhere along the way. Hopefully, you see that this process can go on for quite a while, and at the end of it, your $1,000 deposit will increase the money supply by $10,000. If you don't believe me, pause this video for a moment and add up the numbers in the left-hand column of the table. I think you'll see that we're already more than 60% of the way to $10,000, and the bank still has $387.42 to lend, something which it will be able to do several times over. This process is the magic of the money multiplier. Now that you know how the money creation process works in our banking system, you will be able to understand how the Federal Reserve can adjust the money supply by creating excess reserves for banks. One thing that you should remember is that in normal times, banks don't like to have a lot of extra cash sitting around doing nothing for them. So if they have extra cash, they're likely to lend it out and create more money. However, these are not normal times. This may be part of the reason why the Federal Reserve dropped the reserve requirement to 0. Think about how the process on the previous slides would work when the reserve requirement is 0. We'll talk about this and other ways to address economic downturns next time.